Did you see this? I literally came to fill up my tank and just stood there for 30 seconds thinking, is this real? Because this cannot be real. Oh, it's real. And honestly, it's only going to get worse before it gets better, which is exactly why we need to talk about what is actually happening out there, because most people have absolutely no idea. What do you mean? Isn't this just because of the war? Everyone says just because of the war, like it's some minor inconvenience. But this isn't just about gas prices. This is about the entire global oil market potentially collapsing. And if you're not paying attention, you are going to get blindsided. So let's fix that right now. All right, so here's where most people go wrong. They hear U.S.-Iran war and they immediately think, okay, military conflict, geopolitics, not my department. And I get it. I genuinely get it. But let me show you something that changes everything. The Strait of Hormuz is a waterway between Iran and Oman, 21 miles wide at its narrowest point. And right now, according to the U.S. Energy Information Administration, roughly 17 million barrels of oil pass through that strait every single day. Is this the strait thing you keep mentioning? I keep seeing it in the news, but nobody actually explains what it means. Yes, and this is the part that should make you stop scrolling. 21% of all the oil in the entire world passes through it every single day. Wait, 21% of all the world's oil goes through one 21-mile stretch of water? One stretch of water. And it sits right in the middle of an active conflict zone. This is a your grocery bill story. This is a your retirement account story. This affects every single person watching this video. In the first 14 days of this conflict, the oil price spiked 13%. 13% in 2 weeks. That is not a market blip. That is a market screaming at you. Oxford Economics published a March 2026 report with 3 scenarios. In a short conflict that resolves quickly, oil stabilizes around $110. In a prolonged 3 to 6 month conflict with Hormuz disruptions, they model oil hitting $150 per barrel. And in a full escalation scenario, $200 a barrel? I'm not even going to pretend that doesn't scare me. Good. Because scared and informed is so much better than comfortable and blindsided. And on top of that, Chatham House is warning that a prolonged oil shock sends us straight into stagflation. Is it like when prices go up but your salary doesn't move? Exactly. Prices rising, economy slowing, unemployment creeping up, all at the same time. It is the worst economic combination possible. Think of the global economy as a massive cargo ship. Billions of people on board, engines running full speed, everyone going somewhere important. Oil is the fuel that keeps those engines turning. Now imagine someone just blockaded the only refueling point in the ocean. That ship doesn't stop immediately. It slows, it sputters, and then one by one, every person on board starts to panic. That's a really scary image. It happened. 1973, Arab oil embargo against the United States. Oil prices quadrupled in 6 months. The Federal Reserve raised interest rates so aggressively to fight inflation that it pushed the entire economy into recession. Stagflation lasted almost a decade. But isn't America different now? Don't they produce a lot of their own oil? Yes, the U.S. shale revolution means America is more energy independent than it was in 1973. But here's the thing people keep getting wrong. The global oil market does not respect borders. If 17 million barrels a day suddenly disappear from global supply, South Korea goes into crisis, Japan's manufacturing halts, India's economy buckles, Europe panics. You cannot opt out of a global supply shock just because you have domestic production. You are still inside the system. And look, everyone talks about gas prices because you feel gas prices every week, but the damage from an oil shock goes so much deeper. What do you mean deeper? Like, what else gets hit? Okay, fertilizer. I know, random, right? But your food, the actual growing of it, depends on nitrogen-based fertilizers, and nitrogen-based fertilizers are produced using natural gas. Qatar is the world's second largest LNG exporter, and it sits right inside the conflict zone. If Qatar's gas facilities take any hit at all, fertilizer supply drops. Food prices don't just go up this month, they go up for the next 2 to 3 years. Wait, so the price of bread could actually be connected to a missile hitting a gas facility in Qatar? Directly connected. And then there's helium. It's critical coolant for semiconductor manufacturing. So now you have a chip shortage cascading through the global supply chain. The second and third order effects of this conflict are enormous, and most people are completely unaware. And now, here's the part that should genuinely make you sit up straight, because we haven't even talked about the elephant in the room yet. What elephant? The United States is currently sitting on $36 trillion of national debt, and according to the U.S. Treasury, the government is already paying close to $1 trillion a year just in interest on that debt. So they're paying $1 trillion a year in interest, and now they have to fund a war on top of that? On top of that, the Congressional Budget Office estimates a sustained Middle East military engagement costs $40 to $70 billion per month. And when it borrows more, it pushes interest rates higher. And when interest rates go higher, your mortgage gets more expensive, your car loan gets more expensive, your business loan gets more expensive. It is a chain reaction that starts in the Middle East and lands directly in your bank account. All right, enough bad news, because knowledge without action is just anxiety, and I refuse to leave you with anxiety. Okay, I'm ready. Hit me. First, review every variable rate obligation you have. In a stagflation environment, central banks raise rates to fight inflation, and that means variable rates go up fast. If you can switch to fixed now, before the pressure fully hits, you protect yourself from the worst of it. Okay, that's a real one. What's the second? Watch the energy sector carefully. I'm not telling you what to buy, but historically, sustained oil supply disruptions push energy equities significantly higher. Do your own research, talk to your financial advisor, but do not ignore it. And the third? Stop assuming this ends in 2 weeks. Every serious analyst, Oxford Economics, the IMF, Chatham House, the Council on Foreign Relations, they're all saying the risk of escalation is higher than financial markets are currently pricing in, which means the market hasn't fully panicked yet, which means you still have time to prepare, but that window does not stay open forever. You know what's wild? I came to this conversation stressed about gas prices, and now I realize the gas prices were just the symptom. The actual disease is so much bigger. And here's what I want you watching this to take away. The people who got destroyed by the 1973 oil shock weren't stupid, they just didn't see it coming. The people who came out the other side intact understood what was happening. They adjusted early, and they didn't wait for permission to act. And the people watching this right now, they're not waiting. You watched this video. That already puts you miles ahead of the majority of people who are still scrolling past the headlines without understanding what they mean. Don't waste that edge. If this gave you even one thing to act on, drop a like on this video. Subscribe if you want to stay ahead of what's coming next, and leave a comment. I want to know, are you worried about oil hitting $200? I read every single one. See you in the next one. See you next time, and please go check those variable rates. I'm serious.